basically a data collateral. We're building a deal collateral software that will help founders right from the ideation stage to building your pitch decks, building your financial models, getting a data room. But what is the core of our product is helping founders build models and get those collaterals ready that speak to the investor in the same language. And so that's about me. I would probably like to share about Siddharth now. Siddharth, maybe you can go ahead. He's our founding partner, and he is currently an active head of investment with the Encourage Ventures. Sorry, my voice lagging a bit. Encourage Ventures. Siddharth, maybe you can go ahead a bit. Siddharth, can you hear me?
I think we've lost Siddharth.
Let me check.
On, yeah.
I'll probably ask him to switch off his camera.
Yeah. Meanwhile, we have folks joining in. What I'm going to do is ask you a quick question just to get a sense of where we are all at in terms of fundraising.
That is joining again.
Yeah. We're equally distributed between folks who are still thinking about it, folks who have started but are not sure how to proceed, folks who are in the middle of, their process and they're hoping for the best. I see one person has chosen other. I really want to know what is your fourth option. What is this fourth condition that you are in?
They'll probably ask us, why did you put it in the option?
I wanted to know, is there a case I'm not covering?
There should be one more option for we tried everybody and got rejected.
That's what the other option is for.
अब हम गुस्सा हो गए VC से बाहर में जाओ अपने पैसे लेके. I don't want it.
Sorry guys, I got connected. So I'll just take a couple of minutes to introduce myself. Yes. So I joined with Jagriti around 6 months back. So she had hired me for helping her to build the entire financial model product that we were building. So I was hired by her for part-time kind of a thing around, I think it was May or June last year. But me being from an investment banking background and have worked with firms like Morgan Stanley, Avendus, felt that this product has a very good opportunity. Plus, it's very scalable kind of a thing. Plus, it's a real problem that both Jagriti and Anshul were looking to solve. So that's why I pitched in and I came into them that I also want to be part of the team, and they wholeheartedly accepted it, seeing my vision and my contribution as well. So yeah, I'm a chartered accountant, have worked in multiple organizations for past 6 years now. So right now helping Jagriti and team, and also consulting many other companies raise funds through both venture capital and private equity. Yeah.
Okay, so we'll just quickly get started. So I don't want it to be like an MBA session where I'm presenting and we talk about it. So basically, I've put together, what are the 3 or 4 key pillars that an investor looks for in a company or in a startup when they are, when they approach them for investment. So these 4 key pillars properly researched and properly done. Maybe you can move to the next slide, Cheryl. Sorry about I'm not being able to handle it from here.
Yeah.
So 4 most important things is, one is, of course, the niche.
Or am I using Jagriti?
Hello?
Yeah, her network on that side is kind of disturbed.
Hello, can you hear me now? Oh
Yes.
My God, why? Okay, all right. Okay, so most importantly, the founders, the idea that they come up with, the conviction that they come up with is number 1 priority for every investor. The team that you have, whether they have those capabilities, whether they have that kind of expertise in the niche that you are building. And then the market opportunity, like I mentioned, right? It's not just about the TAM SAM that you calculate, right? It's more about the problem that you're solving for a particular target market. How big is it? Is that problem pervasive? Is it urgent? Is the market going to double in size? How is the market looking for? It doesn't matter if you have a 1 billion, 2 billion worth of market opportunity. How is the market in itself? The nature of the market in itself is what is one of the key concerns for investors. And before I move to model, I'd like to talk about traction. Before we go to, before we approach investors, there has to be some form of traction, whether you're doing it, whether, if you don't have your platform ready, if you're just selling it as a service or whatever, you need to know how your customers are perceiving it, even if it is a traction or a sales number worth, just 5 or 6 months or just a year or so, because this actually translates into helping you understand what is the cost of acquisition. Because based on that, once you have these numbers in place, you will only be able to get to your funding number once you have these basics in place. You cannot just go and say that, okay, I want 2 million. Why do you need that 2 million? In the sense that this 2 million I'm going to spend into XYZ percentage on marketing, XYZ percent on product development, and you get these numbers when you project them, keeping those current industry standard metrics in mind, which essentially is what your business model creates. So these financial models and financial projections that we usually right now are, kind of is available in the market, is available as a service. Either someone is paying 50,000-60,000 to a normal accountant CA who's handling their books to build it, and they ask you, अच्छा आप बताओ आपको क्या valuation चाहिए और हम उस हिसाब से we'll make a projection. But essentially this is the most important backbone when you are going for fundraising. This is your most important deal collateral, because whatever you project is basically going to come back to you when the investors are going to ask you, on what assumptions have you projected these numbers, or based on your industry your assumptions need to be changed, or the conversion rate that you have taken needs to be changed. So these projections are nothing but essentially a breakdown of your current cost, current revenue, and current financial numbers. And then how do you project, where do you see years, 5 years? Doesn't have to be that you are going to raise funds, which is why you need these numbers. If you want to really scale, and if you're a serious founder, you'll definitely want to know, okay, how am I moving forward in the next 2 years, 3 years down the line? So fundraising might still be secondary, but these numbers, these projections have to be realistic, and these can be formed through assumptions. Now these assumptions cannot be the same across every industry. A D2C brand will have different metrics that they need to keep in mind. SaaS will have different metrics that they need to keep in mind. And based on these metrics, based on these industry standards, you have to build your model, which ultimately will help you reach your valuation. And then once you reach the term sheet stage, or once you reach the the final go ahead stage, this is what your investors are going to drill you on, or do the due diligence on. Ki ye number tum kaise laye, kyun laye, how did you get this, why is there a sudden rise in your month on month growth or year on growth, and so on and so forth. So what we have done is that we have kind of divided these 4 pillars into what is to be done from the investor's point of view and the founder's point of view. So founders, we all know, we are all doing it, so I'll probably keep it secondary. If you move to the next slide, Cheryl, I'll hand over it to Siddharth now. So basically, market opportunity team, and traction and business model. इन्वेस्टर क्या देखता है, व्हाट इज इन्वेस्टर लुकिंग फॉर? जब हम किसी के पास किसी को भी अप्रोच करते हैं, लिंक्डइन पे अप्रोच कर रहे हैं या किसी के पास जा रहे हैं, इन चारों चीजों को लेके इन्वेस्टर हमसे क्या पूछेगा? सो प्रॉब्ली सिद्धार्थ, आई विल हैंड इट ओवर टू यू टू टेक दिस फॉरवर्ड.
Yeah, sure. When it comes to market opportunity and when it comes to team size, so basically what the investor is looking for, what's the total addressable size of the market? Is the opportunity big for the investors to put in money? Say, if someone is launching a D2C product, which has a very niche market in India, so bhale your sales are very good, but if the total market size is not so big for the investor, because investor who will be coming at seed A, at seed series, at series A, or maybe series B, so they will obviously want an exit through maybe series CD or through an IPO. So that will only happen if the company keeps on growing much faster than the industry, and the industry is very much huge to to become a company, say a 500 or 1,000 or a 5,000 crore kind of a company. So that's where the opportunity lies, like whether whatever product you guys are doing, so what's the addressable market size, it's very important. And also like how the team is placed, who are the key people of the team, what is their past experience, past background, what are the diverse skill sets from the team. That's also very much important. That's what I feel.
So that, like we discussed earlier in the morning, right? Maybe you can give out these pointers that, what not to say or how not to introduce your company actually.
So yeah, so basically what I've seen is nowadays most of the founders compare their company, can compare their product with different companies. Say we are building Instagram for this, we are building Healthify Me for this. So these are kind of turn off for the investors. So an investor will like that your product is your own product and you're not copying someone else's idea or not building what someone else has already built. So that's why I tell all the founders that be true to what you have built and have conviction on your product when you go to investors.
Yeah. And from the founder's point of view, I think most of us are in this current stage where, we are still validating the problem, and we are still seeing if the problem is, big enough, urgent enough, is the person going to pay me for that? How many of our competitors are doing something similar? So is stage with the resources and collaterals that you can, keep in place and for investment readiness would be if you're running pilot tests, have that data ready. If you're doing user research, have that data ready. Do extensive competitor analysis, extensive market analysis, and all of this, right? And at this stage, investors get really impressed if you have been frugal before you have gotten money. Like, in the sense that have a team that has diverse skill sets, and it should be a matter of pride, and you can actually pitch in a way, okay, I built this entire thing in, XYZ amount. So the more frugal you are, doesn't have to be that, you're not investing money in the product, but the more frugal you are, the more mindset you have that, I can scale my company from 0 to 1 in this fashion, at even being bootstrapped, I have done this. So this is a story that you can build on, and this is a story that actually sells at the end of the day, rather than the having very long ass decks and very beautifully done decks. This is those actually will help you garner the attention of the investor. So moving on to the next two important ones here are the business model. Siddharth, maybe you can start with the investor side.
Yeah. So on the business model part, as we discussed, like the major questions for the investors will be how will you scale your business? How will you tie up with a distributor? How will you distribute? What will be your distribution channels across? Say if you are doing D2C, then how are you spending on marketing? How much percentage of your revenue is coming from your own website versus through Amazon's and Flipkart's, etc. Also when you acquire customers, so what is your CAC? That's very important, like how much you are spending to acquire one customer. If your average order value is say 1,500, how much are you spending to acquire one customer? Then breakup of the entire unit economics, basically what's your COGS, what's your gross profit, and what are the other heads of expenses that you have, and what is the net EBITDA that you are making. Also uh, when you build a financial model, you have to show profitability, say from CM1 level. CM is basically contribution margin 1, then your CM2 level, and then your corporate level. So you have to break up your unit economics in such a way so that if investor asks you whether you are CM1 or CM2 or a corporate level, where are you burning money, so he'll get to know that. Then accordingly, how much are you burning right now and what is the road towards breaking even. So we should have a defined plan that what are the numbers that we are looking that will help us achieve a break even kind of a rate. Then obviously the other metrics will automatically come on. What are the valuation, what are the dilution that the founder is looking into, what are the assumptions that we have taken to project our revenues, to project our profitability, and whether those assumptions are valid or not. We have to obviously justify those numbers. We can't just put any blatant number. We have to justify whatever numbers are we putting on the our financial model.
So when is
So
the right time, Siddharth, for a founder to, get started on working? Because usually founders in the initial 6 months 8 months, we're also busy and so attached to our product कि हम सोचते नहीं है इसके बारे में, और जब हमको फंड रेजिंग का समय आता है तो we are all over the place. So and one question is this, and the second question is this, that once when somebody gives you a number that okay, my projected revenue next is I will do 6 million in 2025, how do you at the first glance, as an investor, look at it, and where are the loopholes? What loopholes are investors looking at when they see somebody's business model?
So loopholes basically, if our assumptions are too aggressive and compared to the market size and compared to what we are telling, it looks very unviable, then obviously there are loopholes. Plus, if say we currently are doing a $1 million ARR and we are projecting $6 million, so we need to have a justified plan as to define how will we like do 600% growth in next 1 year. Our month on month growth should be above 50%, and how and what is the fund that we require to get to that number. That number is also very important. So our cash flow statement should justify that how we are gonna be a $6 million revenue company, and also what's the exact amount that we require. So what I have mostly experienced, that whatever projections I see in Excel, they are most of the times very aggressive, and when it comes to actual what they are doing, it's 100%, it's below 30 to 40% lower on the lower side. So that then becomes a very big hindrance for the founder to raise for the next few rounds. So maybe you have got one round of funding through your projections, but raising the further subsequent round becomes a big hindrance. So it's better to be realistic. It's better. So basically, it's better to under promise and over deliver rather than kind of over promise and under deliver in this case.
If I may, just had
Yeah,
a quick
yeah. Sorry.
question. Maybe not everyone would know about this, but could you explain what is CM1 and CM2?
So basically, CM1 is your contribution margin one. So basically, whatever is your COGS, whatever is your business expenses, whatever is your direct expenses related to the business. So basically, your manufacturing cost, your labor cost, all the other cost, which is your direct expenses related to the product or related to the business that you're doing in. So you first do your revenue minus your direct expenses, which comes into a CM1. Then you subtract all the marketing related expenses, advertisement related expenses, all the other miscellaneous expenses, and comes your CM2 for that individual product. And then it comes your corporate level expenses, your top hire, your management team, your rents, your offices, which comes in CM2, which comes in corporate expenses. So then after all those comes your EBITDA and then your profit PAT.
Got it. Okay.
So Siddharth, maybe we should also, kind of discuss on the fact that for those of us, who are pre-revenue, who have not yet, gotten any revenue, been 6 months into the business, say we have already gone to market, but we haven't really realized any revenue as such, and we are running out of cash, we need to, get some funding ASAP to survive. In those cases, how can a, founder play with his business model? How can he make a investable business model in that case? Or what numbers should... Sorry, Guha is asking something. I'm so sorry. I think I
Yeah,
interrupted.
actually, I'm adding on to what Jagriti is saying. Thanks so much for that, Jagriti. So the idea here is we are pre-revenue, but I mean, kind of post-revenue pre-product, in the sense that we've been running a year-long pilot. We've been running without any tech product in place for the last almost 11 months now. The idea here, the behind that, the rationale was to validate a couple of things, like including our core hypotheses, understand our customer TGs better, patterns, etc., and of course demonstrate willingness to pay, identify monetization models, etc., before we wanted to commit to any kind of tech debt or infrastructure, right? So would that put us and now we're finally building our MVP. It's coming out live. It's already live. We're fixing bugs and basically an open beta. So would that put us in too soon to speak to investors, or should we be already engaging? Because we already engaged and we were told that you're too early, or come back when you have more traction. That's the typical answer you get, right? So from that perspective, in hindsight, I realized that what we've been doing for the last year or so is you can term it as market research, primary research. You can term it as primary research, but we have a year's worth of research. We understand like our market space really very well. So how would no? I'm just tacking on to what you were asking. That right? So we would that be termed as pre-revenue? Because any money we make, we didn't really run this like at no revenue. We were making money, but it's not serious money. It is just enough to demonstrate that there is some market potential or there is some revenue to be had here. We're still not making a loss. Our operations are self-sustaining at this point. So the question was that, like, how would you term it, and would we be in the right space to be talking to investors, and how would we be approaching investors for investment, even at a pre-seed or a angel level, in this kind of a scenario?
Siddharth, you there?
Yeah, I'm there.
Yeah, okay.
So basically, Goa, so what happens normally in pre-seed and angel kind of a thing. So the bet is normally on the promoter. So it's betting on the jockey rather
Founder.
than
Mm.
rather than the business and the product. So it obviously your product and business also plays a part, but it's more of bet on the person and the passion that he brings on the table. So what I have noticed is when you are going for a seed or a angel kind of a thing, you try it with your friends and families first. A small round, say initially, say 1 or 2 crores, you can try raising with your friends and family. And once you are at a certain scale, at a certain age where you have proved that your product is a product market fit and you have already gained traction from multiple people, then you can easily go and approach. Say there are multiple VCs now who are doing seed funding, etc. So you can then go and reach out to them and kind of raise their products, raise the
So in
investments. So
in
yeah.
in simple terms, Guha, I think this will still be considered as pre-revenue, and I think the best people to approach, like Siddharth mentioned, would be angel investors or the new thing that has come, like the micro VC thing, who give like small ticket sizes, so we can pull in together to get a particular amount. Because I think the current scenario, apart from D2C, Siddharth, nothing else is really picking up investors' interest right now, right?
Yeah. So that's the thing, because right now little bit the ecosystem has faced challenges for the past 12 to 16 months. So where there is no sales and there is no revenue right now, it has become little bit difficult, which it wasn't back in 2020 or 2021 to raise capital. So that's the issue many founders are facing right now. But that's what I suggest them is raise a small round between your friends and families or your persons whom you have worked with, who trust you very well, and then you can probably go after some time, and the environment will be good when your product will be a product market fit. So that's when you can look to raise funds.
And in terms of preparing the model at this stage, Siddharth, like pre-revenue, or I've been working or building the product so far, how do they craft their model at that stage? Based on
So
assumptions purely, I suppose.
yeah, based on your assumptions and based on what's the target market that you are looking to acquire right now. So if you know your target customers, if you know what is the potential and how much percentage of market share can you get in next 1 to 3 years. So that's how you build a model at a pre-revenue kind of stage.
Okay, purely assumption based.
Yeah.
Okay, and any key, because I think most of our audience here is from SaaS and D2C. So any key takeaways you'd like to give for D2C and SaaS businesses when it comes to doing their financial modeling or assumptions? Basically, the red flags, what not to do. What do is most of us actually know, but what
No,
not to.
as I already spoke, Jagriti, it's better to be realistic
Hmm.
when you are putting your numbers, and obviously your vision should be there. So it should be a flow. It shouldn't be just numbers which are there. Where do you want the business to be? What's your vision? What's your end goal? where do you see the company in next 5 years down the line. So your projections should become like a story that you are narrating to an investor versus a kind of just a number and a simple thing that you are projecting. And it should contain everything in very much details. If you are manufacturing a product and you are selling it online, so what are your different heads of expenses that you have? If you scale your business say 2x in next 2 years, then what additional capex that you require to do, then how much you are spending in marketing right now versus what you will be spending in future, because right now marketing costs for Amazons and Flipkarts has also gone up. So logically putting in all those data there is very important.
Okay. Okay. And in terms of valuation, like both for, people who are revenue, who have raised, pre-seed or going for the next round, what do founders need to typically, be kind of careful about when they're setting a valuation? Because usually what happens right now, I'm sure we both face this every day when we get customers, is that they've gotten a CA or somebody, from their team to build up a sheet with XYZ valuation, but there are a lot of things which are missing in it. And, investors, when they go for doing their due diligence, it doesn't really play out. So how can they approach setting up a valuation sheet for themselves, which is actually robust, concrete, even if for someone who doesn't have the financial acumen for it?
So when you're going for a valuation per se, so normally if a company is say doing a sales of 2 to 3 crores right now in D2C or another market, it can get a 4x, 5x kind of a revenue multiple. But if you are pre-revenue, then obviously the bet is on the promoter and the product. So normally at that stage, what I've noticed is there is a for the initial round, say you are raising 50 lakhs INR or you are raising 1 crore INR, people don't dilute more than 10% in the first round until unless it's a very big round. So normally the first round is for 10%, and obviously you have the anti-dilutive and the all the other clauses in your term sheet so that in case of any further rounds, all your stake won't go below this some percentage. So that's there.
Okay.
But
Okay. And for
obviously not being so much stringent on the valuation when you are finding a product market fit for your business, because valuation will come ultimately if your product is being used by thousands and lakhs of users. So it's not about chasing valuation right now, it's about getting the capital to start the business and making your product big for the people. That should be the goal rather than to chase that I want this valuation and this number.
Okay. For these, programs that we have, like we have Surge, First Check from Jungle Ventures. So I believe somebody from our community here raised a first check of 75 lakhs for, I think, 5%, or I'm not sure what. So in these cases, when we are approaching these big names who are running these, angel programs and all of this, at that point of view, a common question that comes up in the community is, how much equity to give, or what is the right number that I need to give out? So how can a founder assess कि मतलब अच्छा ये found या ये मतलब investor is not right for me, या investor के red flag है, मुझसे ज्यादा equity ले रहा है, या मुझे कहाँ पे stop करना है pre revenue या seed level पे?
So I think 20, anything above 20% at a pre-revenue or seed level looks very kind of greediness from the investor's perspective, because for a small capital, if there is so much of dilution, so then in future, obviously the founder's equity keep getting diluted at every fundraise. So I think between 5 to 10% is what founders should look at until unless they are going for $1 million plus. So there a bigger equity stake can be possible, but for a smaller one to between say 50 lakhs to 2 to 3 crores, I think a 10%, 5 to 10% equity is what they should look to dilute.
Yeah.
Sorry.
Okay.
My bad.
No worries, no worries. So at this stage, like I think Siddharth already covered most of the things. So as founders, the collaterals that we need to prepare at this stage, once we are ready to reach out to investors, is of course the plain Jane pitch deck. Don't make it too complex, at least for the first, when you're approaching them first, just make a simple teaser deck with basic things about your problem solution, your traction, and where your product is going to go from here, right? It'll just be your first 2-3 slides that are going to garner their attention. Then, like Siddharth mentioned, the valuation written twice over here. It's just one-time valuation. And the financial model is something that you can build step by step if don't want to splurge right away. But that's where we come in. We are trying to build a product that should be very easy and really affordable for every founder. But financial model, in a sense, at least keep track of your revenue, your cost every month, and then keep a projection in your mind that, okay, next quarter I'm going to do this, how much do I need? So going from this is my revenue, this is my cost, I will increase my revenue and I will decrease my cost by this amount in the next quarter or next month. Pick up a number of or a bigger goal that 1 year down the line I need to make 1 million revenue, and then come back from there. Track your data back from there, that to get 1 million in revenue I need to spend XYZ amount in marketing. These are the different marketing heads. I will be needing XYZ amount in per month on month growth to reach here. Once you have these numbers in place, you definitely have at least one skeleton level of the model. Even if you don't have something properly, this easier for you to not only project your number but also be in a position to know exactly how much money you need to raise. Raising funds shouldn't be the sense that you are just getting 18 months of runway. That surviving should not be the goal of fundraising. It should take you from point A to point B. So you should be at the next level of your business, and that is how you will be able to track the numbers if you keep a proper model in place. And this will differ for every industry. Like SaaS has its own metrics, e-commerce will have its own metrics, core manufacturing will have its own metrics. So be aware of what metrics you need to track, and based on that, backtrack your data and calculate it in that fashion. So that's the gist here. Maybe we can move to the next slide, Sharon.
There's a few questions in the chat if you'd like to address them.
Oh yeah, please. Sorry, I'm not able to see them here.
Yeah. I'll quickly read out. The first one is from Joe.
Yeah.
It says, Jagriti, Siddharth, thanks for doing this. The question, how is the funding scenario looking like for the edtech space, given the stuff that is going on with the system nowadays? Siddharth, you want to take that?
Yeah, sure. EdTech, obviously, multiple challenges are going right now with Byju's and all, but I still feel that the space looks pretty interesting when it comes to long-term growth, because there is a lot of opportunities and there are a lot of new things that's happening in the entire space. So yeah, the funding scenario right now is not pretty well for the entire sector. But obviously, if your product is right, and if you have already find a very viable kind of a product for the market, then obviously it won't be so much challenge to raise capital. At least a smaller capital won't be a challenge. Maybe large capital, Series B, Series C can be little tough. What we have been observing since last 6 months is raising small capital isn't an issue. Going and raising Series B, Series C on a valuation which was already so peaked at Series A level. On top of that, if your business hasn't scaled very well, then getting a much better valuation and raising more, say $100 million plus, has become quite a challenge for the investors. So that's where the challenge is. But on a $1 to $2 million, $5 million capital, if your product is good, there are a lot of investors who are looking to grab that opportunities. And India, obviously, it's a long-term kind of a growth story, which most of the investors wants to play it, whether it's public market or private market. So that's the thing there.
That any particular VCs or that are actually right now pro edtech that they can reach out to?
Pro edtech, there are a couple of, they can connect to Axel maybe. Axel has been looking for VC funds. They can either connect to multiple family offices. Catamaran they can also look at Catamaran. So yeah, there are multiple funds which are looking, but not entirely edtech, but the entire tech kind of space, be it health tech,
Okay.
be it edtech. So yeah.
All right.
Got it. The next question is from Kritarth. It says, so maybe we don't want to discuss equity trade-off because the stage is quite premature. How accepted or mainstream are convertibles?
So they are
Very
pretty
actually.
accepted. Yeah, they are pretty accepted at the initial stage. So you do a convertible and then on the next round you give a discount to the investors. So that's the normal industry trend which is there.
So convertibles are okay, good to go, Pratap.
All right,
Yeah.
even at angel, pre-revenue, or the revenue stage.
Yeah.
All right. Ankita's from point A to B versus market keeps changing. How do you plan that? I'm guessing it means if you're
Okay.
getting from point A to B and the market is continuously changing, how do you plan for that?
Assumptions, that's where your assumptions come into play. So you have to play out your assumptions in a way that you're also keeping your best value. You're being you are putting together a model and a data set of numbers which is considering both the worst, the pessimist value, the average value, the best value, the optimistic value. So you will have when we build a model, we have to consider assumption. Simply does not mean that we have one assumption, we take one number against it. You have to plot multiple numbers. So basically this is nothing but planning for a scenario, right? This is scenario planning, standard what if analysis. So you have to take extremes on both ends to put together some benchmarks. There's a SaaS funnel conversion 2 से 3% है. Year on year, yeah, industry on industry इतना बढ़ता है, इतना घटता है. So based on that, you can, be conservative, like make it worse. Try to keep it as bad as possible and then come to a number. If it is good, awesome. But if it's bad, at least you have been conservative about it. So that you can add something if I've missed or anything here.
Exactly as you said, Jagriti.
Okay.
All right. Atano asks, convertible notes versus iSafe notes. Is there any reason to choose one over the other, or are they necessarily the same from a legal point of view?
I think they are almost the same. Only in India, convertibles are more preferable. So, but yeah, from a legal standpoint of view, both are same. Anything is good to go.
Got it. Joe asks, what milestone should we have to raise a pre-seed round for an edtech space?
As I said, for pre-seed, the milestone should be to get a product market fit and to get say 100K users on your platform at least, and then you can easily go and raise say $1 million kind of a fund or a $500,000 kind of a check for your company.
Hey Siddharth, I just have one question for you.
Yeah.
So if you're looking at a SaaS business model, right? And
Yeah.
let's say you are planning to raise around like 1.5 million as a seed round. What I'm guessing the metric would be annual recurring revenue. What have you
Correct.
seen like a usual number that startups go with, where they can be confident that I can raise 1 or 1.5 million in seed?
Say for 1.5 million in seed, you will be obviously looking to dilute say 10 to 15% kind of a thing, correct?
Yep.
So for a 10 to 15%, so your valuation kind of becomes between somewhere between 80 to 100 crore kind of a valuation. So for
Mhm.
80 to get to 80 to 100 crore valuation for a SaaS product, I think you should have at least ARR of somewhere about say anywhere between 6 to 8 crores. So a
Okay,
50
that
lakh
makes sense.
MRR, a 50 lakh MRR will help you raise $1.5 million kind of a thing.
Okay. And does when they are looking at the amount that you're looking to raise, We
Hmm.
can obviously give like, we are planning to hire this many software engineers, or we are planning to spend on marketing. Are these good numbers that we can, showcase to the potential investors, saying that this is how we are planning to spend the money? Or does it have to be strictly be based on, product related items or other activities?
So your hiring for your software developers and managers will also be for your product, right? So
Right.
whatever it takes you to get to say 100 crores of revenue, whatever be your projection in next 4 years or 3 years, the horizon that you're looking to raise funds. So be it marketing expense, be it working capital, be it ad expenses, be it hiring, be it say launching a new product. So entire capacity building for that. So everything can go into the end use of capital. That's not at all an issue.
Yeah, and I think R&D mostly which will SaaS companies put on the product can be amortized also. And one thing, Ashik, when we are dealing with SaaS companies specifically, right? Apart from the usual, metrics of ARR, MRR, churn, cohort, CAC, and all of that, what really has to stand out is how we will distribute the product, because SaaS is such a overcrowded place. Because I think I'm making something unique, but there are 10 other people who are doing the same thing, in a different format. So what really plays
Right.
out for this is how you're going to distribute. The game in SaaS is distribution. So if you're able to put together a projection of how you will distribute per quarter, you're kind of capturing one market, another quarter you're capturing another market. And for these markets, you need XYZ people or XYZ members, in XYZ locations. That gains kind of a bit more trust than just putting together numbers about your, the basic SaaS metrics. So you can put a
Right.
lot of focus on distribution as well.
Right. That makes sense. Thanks a lot,
Yeah.
Siddharth and Jagriti.
Okay, there's one last question from Ankit. Ankit, you can unmute yourself and ask.
So, hi guys. So my question was how to get the industry metric like growth, revenue versus VC perception of the business.
Can you speak closer to the mic? Can't hear you
Ankit,
clearly.
your voice is very muffled. I couldn't get the question.
Can you hear me now?
Little better.
Hello.
Yeah.
Okay.
Yeah, much
So I
better,
was
Ankit.
saying how to get the so I was saying how to get the industry metrics like growth, burn, revenue versus VC perception of those businesses. I can't take feedback from 20 VCs. No, that's really tough for any kind of business.
Siddharth, do you want to take that?
Industry metrics.
Actually, I didn't get the question. I'm not clear what he wants.
In this some form of echo.
I think somebody's giving feedback. Ankit, is the question standard industry metrics from a founder's perception versus what VCs keep saying that this is not standard, this is not standard? So how to solve the problem of every VC having different industry metrics? Is that the question?
So his question is, how do you get the industry metric and everything? Yeah, he says yes, that is the question.
Okay. I think
So,
metrics are, yeah. Siddharth, please go ahead. Yeah.
yeah. So, see, when we talk about industry metrics and what's your perception versus what's the investor's perception. See, when you want to get knowledge about how the industry is doing, there are a lot of data which is available. There is traction, there is private circle, there is VC circle. So you can look at your competitors, what they are doing. There will be competitors who are listed players, or there will be unlisted players who are much bigger than you in the industry. So you can look at them, what they are doing, what they did right to get to the level that they are right now. So, and accordingly, you can pitch to the VC about what you are doing right. So it's all about, so obviously, yes, different VCs will have their different perception. But if your conviction on your business is pretty high, then I think other VC's perception and all doesn't matter much. It's just that how you project your business and what's your, because all the VCs will try to test your conviction on your business model. Their role is to find risks in the investment. Their role is to find uh, your business model to be very easily copyable or
Applicable.
very easily replicable by other people, and your role is to not defend, but your role is to prove that what you want to achieve, it's a real business problem, and what we can do it, it's really scalable. So obviously multiple data points needs to be considered. That data point you will get everywhere. It's very easily available across different platforms. Plus when you will be doing your product, and you will be obviously doing a market research before launching the product, so that also helps you gather those data points.
Perfect. I think Ankit has more to say, but maybe we can take this discussion, a little later because we have about 15
Yeah.
minutes. So,
Yeah.
Jagriti, you want to move on with the presentation for now?
Yeah. Let's move to the next slide. So traction, again, I think we have already kind of discussed this while discussing business model. So investors usually will look for your early adopters, your user base, and if you have had any kind of partnerships. For a lot of industries, if you're building a product or a platform, even if you have not yet completed the platform, or if you have been able to sell it as a service, that also counts as traction, that also counts as revenue. So if you are in that kind of a bracket where you can sell as a service related to your product or something, as a value add to your product, do it, because that is also part of the traction while you are continuing to burn money on building a particular platform. Then for like founders also, they will look at how well you have tested your product. If you have sold, like the same applies if you have been able to make revenue out of this, and if you have been able to partner, because partnerships helps you in cross pollination of leads and so on and so forth. That kind of brings a little bit of confidence that हाँ भाई जो idea आपने बनाया, it's not just all here and say, you're putting in effort, and people are accepting and validating it, and having a kind of a strong robust partnership ecosystem around it, or you're part of one such ecosystem. Again, the same at all of these four stages. At the initial stages, what you need, just have a basic teaser deck ready for introducing to someone. Don't make it more than like 5-6 slides. That's just enough. 10, 12, 13, 14 slides come at a place when you're at series A, B, and when you're talking about your revenue model and you are breaking down your unit economics and your financials for multiple years and your partner programs and all of that. But at the initial stage, your 5 to 6 at basic teaser deck is what is good enough. And your financials, if you are making revenues, and your P&L, balance sheet, cash flow, have that ready to, if an investor asks for it, you can show that as proof of traction. And build on your financial model, at least get those data points in place, so when the time comes, you can either use a product to use it, or you can get someone to kind of build that whole assumption sheet, because it's a very complex thing where you'll have to come back and change it and all of that. But at least a basic skeleton of it is something which all of us must have as founders. So the next few slides are just kind of informational for us to understand कि typical round में कितना मतलब investor का focus क्या होता है, average deal value क्या होती है. So this can be an open discussion. Cheryl, I think we have covered a lot of this already, so maybe we can pick up the topics from tomorrow now. Maybe we can go to talking about term sheet negotiations, on what to expect in a typical fundraising cycle. So that maybe we can talk about the different what is a CCPS round, and see how does a C and C round and happen, and when to take C and when to take CCPS, whether or not to go for NBFCs and so on and so forth.
Sure.
Yeah, sure. So basically, the whatever you mentioned, Jagriti, these are all instruments of funding. So there can be multiple instruments through which the funding can be done. So the ideal deal stage is once the entire your investor is ready to invest, the initial diligence has happened, they will issue you a term sheet. So in the term sheet, there will be various convenience, and there will be various legal clauses that they will look into. So you have to look at what are the rights, whether they have the controlling rights or not, what are the board seats, whether they are getting a board seat or not, then what's the valuation, then what's the anti-dilution clause. That's very important from a promoter standpoint of view. Then what's the vesting period which is there, that's also very important. Plus what's the liquidation preference. So this is the most important kind of clause which so it normally doesn't come much in seed and pre-series A, but in next round series A series B liquidation preference at the time of liquidation, so how much that does the investor get the money, so that's also very much important. When the valuation picture comes, that's the most negotiable kind of a thing which comes, because valuation in series A series B is also determined on your revenue and your profits. Say if in your projections in 2025 you have projected to do profits of 10 crores, so your term sheet will say if you don't do 10 crores, investor will have 15% equity, and if you do 10 crores they will have 10 to 12% equity. So negotiating on that also plays a lot of part. Then it comes on the type of instrument that you are raising, whether it's a convertible note which gets converted based on the next round, or whether it's a CCPS kind of a thing. So normally industry wise, CCPS is the most preferred common share which is used, compulsory convertible preference share. So it converts, it has multiple clauses. What is the conversion ratio? 1:1, 1:2. What at which price will it get converted into equity shares, and what are the terms of conversion? So based on all those things, you negotiate and you sign the term sheet between you and the investor, and then the process of legal diligence, technical diligence, your financial diligence, your GST audits, your income tax audits, your compliance laws, your legal laws, all those diligences happens, post which the shareholder agreement and the share subscription agreement gets signed between the investor and this. So
So
yeah,
recently,
that's a
Siddharth, there was a case somebody had mentioned in the community that the investor was putting a term that they would cap the founder salary at XYZ amount. So this is itself a red flag. So are there any other red flags that founders should be aware of when
this
they
is
are
Jagriti, this is not a red
pitching
flag.
to deal with investors?
This is not a red flag. It's very common in across the industry. Uh, I think your voice is not audible, Jagriti.
Hello, can you hear me now? No,
Yeah,
I forget the number. I think, Sharon, what was the number? They were capping it at like 50. How much was that? I'm not sure if the person is in the
Yeah,
committee.
I
So it
remember.
was a very small number basically, but it was like being very frugal about the founder investor. So is there any, I mean, of course salary capping has to be there. A founder cannot just take 50% of the funding as his own salary. That's a given. But is there a, is there any other thing that from that, as being a founder pro community, or as a founder pro thought, what is it that founders need to just be aware? Where do they draw the line when they feel that something is not right in terms of use of funds?
so basically, normally in all the deals, there will be a cap on salary, and the salary will be decided between the founder and the investor, because obviously you can't take 15-20% of revenue as your salaries. So that's not the objective of raising funds, to get into the pocket of the founders. So number one, this thing. Number two is there will also be a cap on the minimum expense, post which the company will have to take approval from the investor. Say if the cap is say more than 1 lakh, so for every expense that the company is spending, which is more than 1 lakh or more than 5 lakh, whatever that number is. So for which the company will have to then take approval of the investor to spend that money. These are very normal convenience, because obviously they have to see if their interests are aligned and whether there is no misuse of funds. There has been many mishaps by various startups. I don't want to name any in the past, where the funds that have been raised has gone into multiple other places. So for that, but from a founder's perspective, just seeing that if whether is the investor who is coming on board trying to be too much dominative or trying to get into every part of the business expenses or this side, that shouldn't be their rest. I think everything, obviously they also want the company to grow, so it won't be like they are putting too much stress on it, so that's fine.
Okay, Ashik has a question.
Yeah, not a question, but it was more like an experience I had a few months back. So again, I'm not sure if it's a red flag or not, but I just thought I would share. So this was an investor that we got connected through the Startup India scheme. So one of the accelerators that was part of that. And after the conversation happened, one of the things they wanted to do as a requirement was they wanted to have a separate bank account where they would put the money, and one of the persons from the accelerator would keep track of our expenses. So again, not sure if it's a red flag, but it felt like investors who come in and feel like they're micromanaging the founders, I feel like that can become a big problem down the line. So I thought I would just share an experience that I had a few months back with you guys.
Ashik, this normally happens. So every time you raise a fund, there will be a separate escrow account to which the funds will go, and there will be one person from the fund team who will be having all the checks and levy on the fund. So that's a normal practice. Many of the investors don't do it, but most of the big investors have those checks and levy, because obviously it's not a debt kind of instrument where if your investment goes for dud, then you can easily sell the asset and recover your capital. It's equity where your equity can be written off to zero if the companies go shut. So the smart investors cover all these petty risks. mm, Corporate governance is what we call all this corporate governance risk by putting checks and balances in all these areas.
Is this a
I have a
general
question
practice?
around that, which is like you just mentioned that you have this corporate governance, right? How different is it from the norm of, let's say, something like a utilization certificate that usually when you raise some money from a grant or something like that, you have to give some kind of a utilization that accounts for what your usage of the money has been, right? So are you saying essentially that even in a proper fundraise, you would have to give the equivalent of a fund of a UC, or are you saying that there's going to be someone deputed to actually sit and monitor every transaction? I mean, or there would be jawabdari for that kind of a thing?
Not every transaction, but as I said, there will be a limit. Say, not petty transactions, but say if you have raised 10 crores, so on a 10 crores, if you are paying someone, one person to paying a agency, or you are paying a lawyer fees more than 10 lakh rupees, then obviously you'll have to justify to the investor why did you pay him. Because what I have noticed in my previous experiences, there are many companies who have raised $100 million, and then they have tied up with different companies just as a proxy play, not doing any business, and they are transferring funds to them, huge amount of funds, 2 crore, 5 crore, 10 crore, and showing it as expenses in their books, and then taking money back through some different channel from those promoters into directly to the founder team. So to mitigate all those things, there is a convenient that the investor puts, that whatever a large sum of capital which will go to a single institution or a single company or to a lawyer or to your chartered accountant, your auditor, so all those things has to be vetted and audited before.
Kind of like an approval mechanism.
Yeah.
Do we have any more questions?
I think there were a few. Let me quickly. Kritar asks, are there any VC or angel suggestions who actively take interest in the creator economy and media in general?
Angels mostly, I think. Siddharth, we recently did this for one of the creator startups, right? It was managing expenses for creators. What was that? I forget the name. Creator
also don't know, but
specific VCs, creator specific VCs as such, not any specific VCs, Pritha. I think because I have spoken to you earlier also, it'll mostly be through angels or probably micro VCs at this point. Any others, Siddharth?
you can look into this Nijan Capital. So they are based out of Bombay. Neil Behel runs it. So they have one angel fund. So they have invested in a company who runs a marketing company. So it's kind of marketing company for a creator only. So and they have also opened a school for creators.
How to
So
become
you
a
can
creator? Yeah, that's
how
it.
to
Yeah.
become a how to become a creator. So you can look into it. We can talk offline. I can get you connected with with the fund manager there. That's not an issue.
I also have one question around the modeling that you mentioned, right? So Jagriti, you were talking about the
Yeah.
modeling sheet. So how
Yeah.
complex does this sheet need to be? So someone I know recommended that I make a sheet that involves a lot of modeling scenarios where you plug in a lot of variables, and before you know, your spreadsheet is turning into one programming platform. So just trying to figure out where to put the cap on
It
it.
is
And
actually like that. It is actually like that. So, these big companies in Series E and onwards, right? They hire these fancy people from Big Four and McKinsey and all of that who will charge you 200K and give you a very complex Excel sheet. So models are actually like that. There are the different, you will have an assumption sheet, you will have revenue cost and all of that. So this is going to be complex, which is exactly what we are solving at Predict Growth. They're making it so simple that you can just key in numbers and do it. But in general, financial models are exhaustive, Goa. They have to be exhaustive by the nature of it, because you have to plan for different scenarios. You have to project for different numbers. And projection is not only for one metric. Data projection will be for each and every attribute that will ultimately contribute to a P&L, balance sheet, and cash flow. So you will have to project 5 years worth of data for everything that comes under your marketing cost and your any other direct cost, indirect cost, your different channels of revenue. Per channel of revenue, how much revenue are you expecting? Because ultimately, like I said, right, it's not just about projecting a number that I want $1 million. Why do you need this $1 million? And where are you going to spend it? That is one way of backtracking it. And if you are saying that I want say I'm going to do 100 crores worth of revenue in 2025, how are you getting those numbers? So this is essentially what comes back into a very exhaustive, very complex business model where you have to do lots of what if analysis. So a general nature of model is like that. You will have like about 20-30 sheets in that Excel.
got it.
Siddharth, I think you have made more than 20-30 also.
Yeah. More than 100, I think.
Got it. But at a pre-seed or a seed stage, does this need to be really that complex? Can we like take, let's say, 20-25 variables and model with a limited set and put the rest under assumptions? I mean, I'm sure that we can break it down to every single mode of marketing known to man, but at a pre-seed level, I don't think you're going to get into that level of
So at
detail.
a pre-seed level, see what you have already done, you will of course take that data set. But from pre-seed, you want to move to the next level, right? So projection, the model is basically projection for the next 3 years or 5 years. 3 or 5 is what they see. So in the next 3 years, if you are going to add more channels, you have to accommodate those numbers, maybe 2024, 2025. So just like how you are expecting a company to grow, similarly, your data set is also going to evolve for each and every year. So line items will automatically keep getting added. So, I mean, of course, it'll not be very complex at pre-seed, but at least the minimum that we have to do is show a growth projection for the next 3 years at a minimum, which will require a little bit of doing A/B testing here and there for different assumptions and different metrics.
Got it. Fair enough. Thank you.
Right, we have a question from Tinker Village.
Hi, I'm Balaji.
Hi, Balaji.
Hi, Balaji.
Tinker Village is our startup.
Yes.
I just, Jagriti and Siddharth, from your perspective, which are there any startups in the Series A, B, C kind of phase, which are benchmarks in terms of how well they are managing their governance, compliance, their fundraise transparency, etc., etc. If you wanted to benchmark, because we always hear the negative stories. Who are the role models in the space in especially in the series A, B, C kind of range.
Should I say Zepto? Siddharth, do you
No,
have any more? From the top of our mind, I think it's Zepto. It's doing really.
Um, there are many companies who have done good. Zomato has done pretty good. The kind of corporate governance, strong corporate governance measures that Zomato had, and from Series A, it has gone all the way to IPO and has like kind of done well post its IPO as well. So yeah, there are many examples of companies you can get it online, but the major thing, the common thing between all of them is very sound corporate governance measures, and also like there were many times when the business was not doing good. It's about how you are convinced so that you can convince your investors to put in money. So there was some time in Zomato that they were not being able to raise funds back in 2020, I think, when there was a lockdown. But somehow they managed the entire 6 to 8 months, and that's why they went for an IPO, because raising funds at that point of time was difficult. Now it's doing pretty good. So yeah.
thanks for that.
So it's basically having a lot of money, but still kind of being a little bit frugal about it and trying to maintain a lean team. So most of them, if you see the best use cases have been frugal despite having money. मतलब अंधाधुंध पैसा खर्च नहीं किया, ऐसी lavishes office नहीं खरीदी, and having a well structured team that complements each other. कि मतलब if everything falls apart, at least you have one core team that can still run it, not just going through that cycle of hiring and firing and hiring and firing and just losing all the money. Okay.
All right. We've already crossed 9, but folks, if you want to stay back and if Jagriti and Siddharth are willing to continue, we can take maybe.
Yeah, sure. If you have more questions, we can get it done.
So there's a question from Purvan. She's asking, what are your thoughts on government grants for MVP stage of software products? How easy or difficult is it to raise government grants? And what are the things one needs to keep in mind while raising government grants?
Mostly from like Startup India kind of a thing. I think there's also the basic. Yes, Guha. So that you want to take this question first?
As you said, so there are many platforms where you can take government grants. But I think for getting a government grant in a SaaS-based product can be little challenging and little difficult to get, because then a lot of approvals and everything is required. Government grants are normally easy to take, where your product comes under, say, some Pradhan Mantri Yojana kind of a
Like
scheme, or
e-waste, something on
e-waste. Yeah.
sustainability, something on women
Correct.
empowerment, or something that is actually kind of blending in with what the government's 5-year plans are. So that's easy. But
Correct.
regardless, when you're raising funds, you will still have to talk about your model and talk about your, basic, if you're making revenue, you still have to give these collaterals anyway to the government. So, but grants are good. If you can get grants, why not? Why not? I think a lot of colleges and also are giving out grants. So before, I think, going to investors, if there are options in your industry to get grants, go all in for it.
I'm just tacking on to that question. So grants are of course good because obviously they come with no strings attached. But
Yeah.
when it comes to SISF, right? So I just want to understand what the VC outlook or or private investor outlook is for a startup who's raised money through SISF or something where you got an OCD or a CCD issued out to the incubator, right? Typically, the incubator is the one with whom you do the instrument. So again, the terms are usually going to be something like 5% at a 10 crore valuation or something like that. Again, it really boils down to how hard you can negotiate in that investment committee meeting, right? So, but then I've heard one or two investors tell me that those terms are really not very investor friendly, so they balk at them. But there are others who are very ambivalent. But beyond the 2 or 3 interactions I've had around this, I don't have an insight. So I'm curious to see how the rest of the industry looks at it. Yeah, that was the question. I'm sorry. I'm done.
All right. Siddharth, do you want to take that?
Sorry, I forgot to unmute myself. They don't they don't look at it negatively as such that, if you've gotten some sort of funding or incubation from incubators. Most likely kya hota hai, incubators say, you'll find through their network and you will probably raise another round. But as such, I don't think there are any limitations, like any mindset limitations for startups who have raised funds in this fashion. Siddharth, any other insights? I think
Mm, actually, it's little bit difficult to get grants nowadays, but obviously the challenges are there. It's more difficult to raise from grants rather than VCs. So VCs are much easy than going and
No,
raising through
basically,
grants.
Siddharth, I think you missed the part of question where he's asking is basically अगर मैंने मतलब incubators के through लिया है कोई किसी तरह का fund या किसी incubator ने मुझे fund किया है and I have working now I'm going to a VC. So do VCs have any presumptions about these kind of startups, which I think are no, right? It doesn't matter if your product is well, if you're scaling enough.
Yeah,
It
yeah,
doesn't
yeah.
matter if you raise funds to incubators or somewhere else, right?
Yeah,
So no, as such,
correct.
no presumptions as such go. I think it's okay. No, VCs don't have any limitations for startups who have raised funds this way.
Got it. No, but the reason I'm asking is specifically 100x, for example, they prefer that you
Huh.
don't have an exposure of more than 5% to anyone outside. So essentially, if you go to a OCD route and the incubator's taken a good chunk out of your equity, let's say 5% at 10C, then that kind of puts you at odds with 100x and their outlook of saying that we don't want someone who's already taken money where they have to give away
So
a
much equity, given away so much equity to
yeah,
an incubator.
I'm just looking from that perspective because we were kind of in the second round with Ninad and his team, and he mentioned that to us directly. So that's what I'm saying.
Achha. But then again, this would be this is particular to every VC, Guha, right? Every VC will have their own vision of how they want to pool their funds and what kind of portfolio companies they want to have. So it'll depend from VC to VC. 100x is like playing a big game, right? So they have like this huge pool of startups. They're one of the top ones, right? So I think that is why they think that instead of incubators, I should be probably they want to get a bigger share and playing long term. But otherwise, it'll really depend on VC to VC, and every VC firm will have its own kind of a criteria for startup. So it doesn't really uh, play bad in the favor of, play unfavorable for the founder, I would say. Or is it, Siddharth, any other VCs apart from 100x who are not keen on getting people with already 10 to 5% diluted with some incubator?
Normally, what happens is if a big VC comes and if he's not comfortable with like incubators on being on the cap table or
He'll buy it
say
out, huh? He'll buy it out. Yeah.
he'll buy it out. So that's in
Okay.
Bharat Pay and all when they went for more Series B, Series C, Series D. So Let's Venture, etc. all were bought out by the investors, new investors. So they do a
बेसिकली अगर कोई
second.
बड़ा इन्वेस्टर आता है तो छोटे इन्वेस्टर्स को वो खरीद लेगा, मतलब उनके शेयर्स खरीद लेगा and give them an exit, and then they will redefine the cap table.
Yeah.
Got it. No, but I'm asking from a perspective of, let's say in my own scenario, like pre-seed, maybe pre-seed, right? So in this scenario, every time an investor frowns, I'm sweating. So I'm worried about that, which is why I'm very honestly asking you, because the idea here is that, of course the SISFS is very tempting target, and like Ankit just mentioned, you get 3 incubators, all 3 don't have money, and you're pitching to uncles. They don't understand your market. But in the off chance that you somehow land the money, and it rains that day and you make the money, then I should immediately be worried about, oh god, now 100x won't touch me. So that is what I'm trying to figure out, how worried should I be about that? So that was the
Not too
primary.
worried, because if the product is scaling well, and if you get a big investor, the general norm is that one solid investor will buy out the smaller ones, and probably through that network you will get more investors. They usually will pool in their own network of investors. That's the usual norm. If there's anything else, maybe Siddharth can add to it, but this is the usual norm that happens.
Got it.
Yeah. Yeah.
Don't be too worried about 100x. There are many out there.
At this point I'll take whatever money I get. So
Okay.
Okay, there's a question from DK. I think that's Deepak. Are you still on call? I think he's
Yep,
still-
I'm
yeah.
still on call.
Yes. So his question was, before PMF, isn't the model going to be very wrong? Because we don't even know which assumptions do we take for our business. This is before PMF.
Not very wrong. At least you will have the standard industry assumptions, right? The standard industry metrics that you have. You can take that. Now PMF is going to change, but at least you know what target market you're going. Your ICP's nature is going to change. The pricing will change, of course, based on once you are going to the market. You will realize get ये ICP के पास तो पैसा ही नहीं है, या this is not the amount I will get. But if you're going for SaaS, right, the standard metrics, the standard conversion, the LTV to CAC value, all those things remain the same. Take the most conservative number and move forward from there. It can't be all wrong. The basic skeleton should be okay. And investors also know कि अगर तुमने PMF achieve नहीं किया है तो ये numbers change होंगे. तो during the entire conversation, they will probably, most likely they will tell you XYZ assumptions need to be changed and you have to come back and tweak the model and project numbers accordingly. So this is practically what happens. Siddharth, anything else? If I have missed, please add.
No, as perfectly you said, Jagriti.
So basic standard industry metrics के हिसाब से you can put a model in place, have the best case, worst case scenario in place, and if you get an investor in your back pre PMF, then they themselves, if they find that this is a bit risky or there's some reassessment needs to be done, they will tell you what metrics to change and redefine the model and see where the valuation comes and how much money you need and how much revenue you'll be able to make based on these changes that they have asked. Typically, in a cycle, they will ask you to change models. If you're approaching, one model will not probably work for all investors. So हर investor को हमको थोड़ी अलग कहानी बतानी पड़ती है. कभी deck में 2 चीजें change करोगे, कभी model में थोड़ी बहुत चीजें change करोगे based on how it's going. But usually अलग-अलग scenarios पे investors will want to vet the model to see that it is robust enough. It is not like Siddharth said, it should not be easily replicable, it should not be easily breakable, but it should sustain itself with the given money.
Okay, Jay, just to quickly answer your question, there is an option that says raise hand. That's the palm symbol to queue in. Balaji has a question, after which I will be taking up Arun's questions.
All right, thanks so much. Quick one, are there any downsides to raising an iSafe for an angel round of, let's say, 5 to 10 crores?
Downsides. So that you'll have to take this. I don't see any.
Nothing downside. Like,
Yeah.
what's your concern on the same?
Cool.
I don't see it.
Then do you have any concerns as such, Balaji?
Yeah.
No, we were just debating. We'd like
Acha.
go for an iSafe, and obviously, investors would want a fixed valuation. So I just want to understand if there are any, because I have not executed an iSafe in an Indian environment before. I've done it before in Singapore. It's very straightforward. I want to understand if there are any down. Sorry.
I said I was in Singapore for past 10 years, so
wow. Okay.
I get the ecosystem there.
Yeah, it was extremely straightforward. So I just want to know if there's any from either transaction cost standpoint or time or any downstream, any implications. Is there any kind of downside or any yellow flags that we should be aware of?
Nothing per se. It's if the instrument, the legal terms are good, then it's good to go ahead. No issues.
One question around that is, if you put a valuation cap on your iSafe, right, and
Yeah.
or if you have a discount, so discounts are a fair game. I mean, a lot of people use discounts on the iSafe depending on what stage they are in, and how much they like their investors. But if you put a valuation cap and tomorrow your valuation shoots up way beyond what you estimated it would be, that's a happy scenario. Then obviously you're going to bleed a lot more equity than you originally envisaged. So I think that that's something you should be worried about, or rather you shouldn't care about. More is good. But on the downside, if you put a valuation cap and you didn't grow as fast as you thought you would, then that's going to be it's going to be a little nasty. So you would bleed more equity. So that's something that you want to be cognizant of. If someone is asking for a valuation cap, that's something that you should kind of keep in mind.
Thanks for the tip.
Anytime.
Okay, awesome. Jay.
Cheryl,
Yes.
am I audible? Hi.
Yes.
Thanks for the session, Jagriti, Siddharth, and of course Cheryl. Just wanted to share something that I feel could be relevant to many. Won't take more than 2 minutes. So, first of all, the idea that a person can raise about 1 crore from friends and family, I feel in most scenarios for most people would be a bit unrealistic. What we did was we did raise friends and family, and for those projections I did something that you mentioned pretty well, which was go really bad with your metrics, show them the worst metrics possible and still show that it is still rosy. We did that. We raised around 15 lakhs so far from friends and family. That has been our runway for the past 2 years now. It's not been 2 years, but we still have money in the bank to go ahead because we have minimized our runway. The other thing is we did qualify for 100x VC 1.5 years ago. We didn't accept it because of those terms that felt a bit too much for us back then, and we were hoping that valuations would be better otherwise. I've also spoken with several VCs including Neon Fund, so many that I've forgotten many of the names, also Mass Short VC, and I have heard that the valuations are at an all-time low. Also very tough for anybody to raise, especially pre-seed. Expectation has become, like you have rightly put on your slide, which is PMF. Everybody wants to see that. Even from good VCs, we were told, okay, earn 100K in revenue and then we'll give you a $2 million valuation, which didn't make sense to us at all. So many of our friends, for example, at Product Folks, they have advised us to try and bootstrap as much as you can, get in that revenue. And I also had a question here, which is, even to make any kind of projection at this point, when paying customers have only been there for, let's say, 2 months, has been something that people will look up to and say, "Kya re, ye to recent hai, so it's too early to say if they're going to stick." Although we do have all of our customers on the annual plan, so we know for a fact that they will stick for the entire year because they already paid. But in the sense that, if you're raising pre-seed or even primarily pre-seed, most people will be raising when they just got money. So how do you cater to that aspect, that you show projections based on a period of time that doesn't necessarily show that it might continue? Like 2 months, and we just got paying users for 2 months, and there is some consistency there, but it's not enough to, let's say, predict, because somebody might just come in and say, "Okay, it's just been 2 months. How can you predict for the next 1 year? Maybe it's just an uptick for now." You're mute, Jagriti. I'm sorry.
Sorry. Jay, we can just break this question into two parts. एक जो हमने शुरू में we had discussed, right, that if I don't have any revenue at all, I'm at zero revenue and I am just burning money, I need some cash. So I start with zero. Just मैं शुरू से I have put imaginary numbers based on industry metrics and I project from that way. Given that you still have 2 months worth of numbers, so people are pretty common to project like 2-3 months, एक quarter का लेके based on month expected month on month growth. If you have 2 months, you at least have one number ki acha, my month on month growth is this much. Typical cycle will take about 6 months. Six months is a good number, at least decent 2 quarters worth of number to see ki acha, quarter on quarter growth is this much, month on month growth is the ideal. The most realistic way is at least have 6 months worth of number and then project from there, because then you have quarter on quarter growth, month on month growth. And then again, like the same standard follows, that you put the best, the worst, add more metrics, add more जितने भी आपके cost हैं, you have to project based on जितना आपको revenue चाहिए next month में, you keep adding cost. You have to also cater to things like, suppose if you're into an educational, if you're into ed tech, or if you're giving something to school, any kind of software to school, so they have a closure in the summer vacation, then that is going to be a downtime where you will not be making any sale. So if you're able to put these realistic basic benchmarks into it, it's okay to project, because the VC will also know, the investor will also know that you only have data worth of 2 months, 3 months, 6 months, uske basis pe aapne kiya hai. So industry metric ke hisab se you can move forward with that. Anything apart besides this, I think they come back with the feedback that this XYZ assumption is not correct, but at least have a basic projection. 6 months is a good time. 2 months probably too early for sure, but 6 months of data is good enough to get started, isn't it, Siddharth? Mostly we do it for 6 months and 6 months onwards, right?
Yeah, 6 months to 12 months is the sweet spot that we
Ideal,
can
yeah,
start
sweet
with.
spot, yeah.
And then probably as and when we keep on growing more customers, then we keep on adding every quarter post that.
Yeah.
Sure, yeah.
वैसे
So
भी typical investment cycle will take 6 to 8 months easily. तो उसमें तो आपके numbers anyway change होंगे by the end of it.
So I've observed a small paradox, which is if you start talking about revenue to investors, they only see revenue and nothing else. And sometimes they steer away the conversation from team, or sometimes, unfortunately, I've never seen a VC talk about innovation. To an extent, I feel that most Indian VCs that way don't really think about it at all. In that way, right, we also at some point started thinking, let's try and connect with VCs abroad. Maybe they would
Hmm.
understand what innovation really stands for, because we are not building a clone. Most SaaS tools, unfortunately, at least 90% of the ones that we have seen are unfortunately clones, and they just want to see numbers because that is one metric that tells them whether it's going to live or not. So I'll just share what Neon Fund told us. I don't remember that guy's name, the main guy there, but he said, there are two parts to it. First is enterprise clients, and the other one is SMBs, which are like
Subscription.
small clients. Yeah, so yeah, for subscription. So either get 200, 300 small customers, or you get two, or just one or two really big enterprises use your tool, and that qualifies you for a round with a VC. The only, again, paradox here again is VCs don't really understand how the product really grows. Most of the time you can't directly serve large enterprises, so they're not willing to bet unless you have those numbers, which, like you said, right, eventually will take 6 months of making revenue, obviously.
Hmm.
So just making this point, final point, which is, when we started, we thought at some point we'll have some kind of rescue, which would be some means, some resources from some VC to scale
Hmm.
up. Now we have only seen that happen primarily in, let's say, the possibility of getting any resource right away would be an accelerator. So we are exploring
Hmm.
accelerators such as Upekha for B2B SaaS. And I hope ki, similar path, I'm more than happy to discuss with others. Our journey has been, but this is what we are at right now. I just thought I'd share that.
B2B SaaS इंडिया में ना, एक तो इंडिया में SaaS बेचना भी बहुत मुश्किल है. It's a different, people don't want to pay 100 rupees also per month. उनको वो भी बहुत ज्यादा लगता है. So that's a standard. Even established companies are struggling to distribute in India. So I think that is a general consensus from VCs when it comes to SaaS. Enterprise SaaS, like again you mentioned, it is not easy to make a product for enterprise SaaS. It is so exhaustive to build their entire product and code it and test it and give it out. And custom project is
You're
not
right.
really going to help.
You're absolutely right, but sometimes the fallacy is this, that VCs will steer it another way. For example, if you make an Indian customer pay 299, which is what we are doing for
Hmm.
many seats already, like
Hmm.
30 plus seats,
Hmm.
then a VC is going to come and say, oh, you don't have international customers, that is no validation. So you've made somebody pay who doesn't put their hand generally in their pocket, but now that is not enough. And if you get international customers, they're going to come back and say, ki, oh, we need you to up your revenue. And this has happened with multiple companies that I know. And at this point, we know very good SaaS startups, at least. All of them are doing very good work. But I
Hmm.
see that as a very paradoxical situation that VCs put you in. I think ultimately it's about, they've already judged you based on your team, based on what you're building at some point,
Hmm.
and either they will invest or they will not, and they have probably made that decision already. If they're
Yeah,
talking about
initially all SaaS companies, the first thing that they will see, distribute कैसे करोगे, तुम्हारे से और नहीं है. Like how are you going to distribute it? And if you get money, then how are you? Because if it's solving a global solution, global problem, then how are you scaling? So that's usually the big pricks that most of us B2B SaaS companies get. But so that in general, how is the Indian ecosystem looking at B2B SaaS companies currently?
It has been a little difficult. We were looking at a legal tech SaaS player who were looking to raise funds, and they had enterprises paying them almost 10 lakhs a month. Still, it was very difficult for them to raise funds because their stickiness in the business is pretty low. So there are many products in similar size. And when it comes to enterprises, what happens is the approval process for taking a new product takes a lot of time
Hmm.
for them, to which lot of these SaaS companies faces a lot of issues. So I
Yes,
know a
there will
couple of
multiple approvals, especially in established companies. Then again, enterprise is not sustainable for early stage SaaS startups, because with enterprise comes implementation. Then you have to spend, resources to implement the product for 2-3 months. That itself will cost you a lot of resource cost, and then you have to do multiple customer support. And एक बार customer को custom बना के तो हर बार custom feature ही मांगता है कि ये भी दे दो, वो भी दे दो, ताली बजाएं तो invoice निकल जाए. So it's very unrealistic. So at least for SaaS, even if you're going for B2B SaaS startups, the best way to start off is to get self-serve. If we can achieve a sweet spot in the self-serve, then of course the end goal for B2B SaaS is enterprise. That is where the money is. So, but initially to get a sweet spot in self-serve would be ideal to lure the investor.
Hey, so just want to add a small point here. You're absolutely right. The actual money is in enterprises only. I'm sorry, just one moment. I'll take. So when we were speaking with, let's say, Neon Fund, right? They only primarily
Yeah.
focus on whether you are serving enterprises or not. That's it. That was their way of looking at things, and I
क्योंकि उसमें
believe.
पैसा रहता है ना बड़ा, एक बार में मोटा चेक आता है तो तुम्हारा 100K का एक
Yeah,
डील
so
कर लिया तो
but it could also be a death sentence to a small startup to try and pursue long sales cycles, because you might never get anything out of it. So what
correct.
advice that I have heard, and we are yet to validate, but we are on that path, is simply keep moving on with the target market we have. Try and go deeper into a particular segment. Like for us, it is architecture firms we are focusing on for Shram. It's supposedly doing pretty well there. Even if we capture a good enough market there, we could be making 100K ARR by the end of this month. We will be in a position, even without any VC support, to command a better valuation. Or in the next few months, we'll not be losing money. We will not be burning any cash. So we could be self-sustaining as well. That has been our only way out of this situation, because we don't have any connections in the foreign VC firms or that community. So that's
A
all
lot of
I.
these SaaS companies, they try to go the way of marketplace, like AppSumo and all. AppSumo pe multiple SaaS companies will launch their product, but the problem with AppSumo is that कि मतलब कौड़ी के भाव पे चला जाता है product, because they generally cater to lifetime deals की 999 पे दे दिया lifetime deal है $99 पे, and then you will get a lot of traction from there. Probably if you pump in a little marketing money, then more traction. But then you will have to, as a SaaS company, you will also have to then spend money on supporting these people, building a closed feedback loop and all. So there are ways, but then again, you need to have at least, either you have a big team or you have a big bank account. So अगर big bank account नहीं है तो team या तो multi. So you can probably try AppSumo J. I think it's a great place to at least
Yes, so
test the
at least
product
in
and
our
get started.
case, right, our approach has always been to have a very highly competent small team, and that's it. That's the way that we want to do it. And we
Yeah,
at this moment are so comfortable with each other working for a year that our burn is also low. And to some degree, a large part of this is because of how we have distributed equity in the team as well. Nobody complains, nobody demands extra money. Everybody is aligned with the vision. I feel that has a lot more leverage than any VC's money in making this actually work long term. So
agree.
All right. Thanks for sharing your experience, Jay. We
thank
are now at 9:30 and there are still a few questions that need to be answered. Arun, if you're still on call, I'm going to take your question next. He asks, how do you raise pre-seed for a sort of deep tech platform where investors generally are clueless, but there is a good demand from the industry one is in?
Deep tech would be Siddharth. I really have not worked with any deep tech startups.
Siddharth, do you want to?
The one deep tech that I know is in the this thing. They're into the cultivated food. It's called Shiok Meats Singapore. So they are into deep tech and getting into lab grown meats. But again, I mean they also pretty much raised about like 30-40 million. But then again, it was based on it got into trouble because of lot of regulatory issues, and different countries did not allow, so, and then sourcing of materials. So it's a big risk. I mean, people who understand, VCs who understand that and willing to take risk big, definitely bet big on deep tech. But how is the ecosystem in India? Probably, Siddharth, if you know a few use cases for deep tech in India, maybe you can highlight them.
Honestly, I haven't also done deep tech per se. Maybe we can connect offline and I can connect you with my other say colleagues who
VCs in the
specializes this
circle, yeah.
industry. Yeah, who specializes this industry so that you can get help from it.
All right. Arun's next question is, which are the VC or micro VCs who are interested in the EV space, if you know of any?
Right now, I think all the VCs are interested in EV space. So it EV both on the commercial plus passenger vehicles and also on the renewable energy side. So almost the sector is doing pretty well. So almost every VC that we speak with are interested in the entire space right now.
All right. Deepak had put up a question some time back. Valuation cap, discount, or both? What's the go-to?
I think discount is what is much better than valuation cap.
Any particular reason why?
See, once you get the funds and you tell them that from the next round we'll give you a discount of say 20%, 25%. The next round there can be a valuation of say 100 crores or 150 crores. So from a founder perspective, you are getting this money at say 120, 130 crores. So you'll have to dilute less. Or if you go for a valuation cap of say 50 crores, and then your next round happens at 150 crores, then obviously your valuation will be high. Your dilution will be high, sorry. So that's why from a founder's perspective, discount is much more viable than valuation cap.
All right. Guha's question is, do you know any VCs or micro VCs who are into Web3?
Web3.
Web3, I'm not
Currently, not
aware.
much. It was a big bubble back in 2021, but currently I think it's really gone quite down. That and any Indian VCs right now in Web3, at least in the Bangalore ecosystem, none that I recall of Siddharth.
Yeah,
I think
I'll have to check on.
The Polygon's founders were trying to invest in these Web3 based startups, if I'm not wrong, right? I mean, apart from them, anyone else?
Mainstream VCs currently, at least in 2023, 2024, the Web3 is not really a portfolio that they are, actively doing it. D2C is at the top right now. So D2C is the Web3 of 2023, 2024 right now. Not Web3 per se, like as an active pursued by VCs.
Got it.
Because asked, do VCs invest in the retail or the franchise space?
Yes. So that maybe you can disclose the latest model that VCs are making money from retail space.
Yeah, they do invest in retail and franchise space. Lenskart has got a lot of funding in the retail and franchisee space. There are other D2C brands. I don't remember the name exactly, but yeah.
Moko, that luggage brand, Moko Bora.
Mokobora, it's not a franchisee kind of a thing. So they are doing
But
their
at least
entire.
D2C, yeah.
Yeah, it's D2C. They are doing their entire sales online, the online platform only. But yeah, if your business is scalable, uh, you have opened a lot of franchises across the country and you plan to open more franchises, then there are a lot of money that is there to be taken along.
And now when D2C investment is happening, mostly if just to kind of like put it as a safety net for investors, they'll probably ask you a royalty or a fraction of your, monthly revenue so that they can, keep making back their money. This is the latest that's happening in the D2C investment space.
Yeah.
Okay, I can't see any more questions. If anyone has a question, you can unmute yourself. But otherwise, I think I have covered all the questions in the chat. We are a very chatty group. There's a lot of messages to go through.
Maybe we can just unmute and take the question if somebody has it.
Yeah. Guha thanks you for the session. He says it was very informative.
Thank you. It was so fun finally catching up at one place apart from the chatty group.
Yes. Okay, I'll just stop the screen share. We can all just look at each other's faces.
Hey, Adhanu this side. Hi, Jagriti. Hi, Siddharth. Thanks for the session. Just quickly wanted to touch upon this question. Not sure if it was already answered. So, is asking for board seat from the angels at the pre-seed stage very common?
Not at a pre-seed stage. I think board seat normally comes in Series A.
Okay, so not even seed.
Yeah.
Yeah.
Understood. Yeah, that helps. Thanks.
So one thing I do know is generally Antler and the like, they take a board observership. They don't take a board seat as such.
Correct. Yeah.
Okay, so how that is different from legal
So they
standing?
don't have the voting right when they
No voting
Ah,
rights, yeah.
I see.
board observer.
Got it. Got it.
Something that you should also look out when you're looking at the term sheet, whether the investor is asking for voting rights and all of that.
Understood. Thanks.
Okay, folks, if you have any more questions, you can unmute. Else, we will reconvene the session tomorrow at 8 p.m.
I think we covered everything today.
Pretty much everything.
Yeah, so the tomorrow session is also covered today itself.
Yeah, but there's a lot of folks who have not been able to attend today's session. So let's
Okay. All right. Yeah, sure.
yeah. Any more questions, folks? You can unmute yourself and ask.
Hi, can you hear me?
Yes.
Yep.
Yeah, so this is which I asked few questions, but then since you're asking to ask the last question here, this is a slightly different question. Like since everybody has been convinced on CCPS, right? I have a very slightly different question. I mean, say take authorized capital, for example, right? So if CCPS is very common, how do they raise capital without increasing the authorized capital? If you look at the cap table, the shares and all that, right? It's been very low, like 1 lakh, but they raised say crores and crores of rupees. Any idea how that has been done? I'm not from a financial background, but just wanted to know if you know it, right? So just wanted to know how is that done?
Arun, so normally what happens is first you get authorization to increase your authorized capital. So that can happen through various means, say a bonus shares or etc. etc. If you're going for a pure equity, say if you're going for a CCPS kind of a thing, so right now your shares are not getting converted into equity, right? So it's only a compulsory convertible preference share will be converted into equity in future. So by when the time the equity will be converted, they will increase the authorized share capital, and I think bonus shares or share split or other mechanisms can be used to increase the entire capital base number of shares, and then that can happen. So for CCPS, when it comes to a question for CCPS, uh, looking at just authorized share capital, it doesn't make much of a sense. When you are issuing a common stock, which is equity shares, then you will look that most of the companies will first increase the authorized share capital, and then they will increase common equity.
Yeah, it makes sense. So I have another similar question. So when somebody is doing a DD, as in an sort of indirect DD, as in look at the papers that we have submitted in MCA and all that, what's that matters to them for a VC that it should look okay? These are the factors that is okay tick marked from their whatever documents are filed in MCA. this is okay and this is not okay. So any idea what are those things that they will actually check?
So basically, all the regulatory documents, which are your ROC filings, your annual reports, your balance sheets, your trial balances, your profit and loss account, your EOC4, MGT7, all the statutory documents, they will look whether all the compliances has been made, is the PF deposited, is the TDS return has been filed in time, are the GST returns being filed in time. So all the regulatory compliances is what they will look.
Yeah, sure. Thank you. Yeah.
So there is no individual like founders के ऊपर any checks and balances, like when you do when we hear about, oh, the VC, we will now look at doing the compliance checks on the startup before we send you like a like the whatever the execution, right, from the term sheet to the SHA. So obviously we are looking at the compliance in terms of the corporate compliance, like, but are there any other checks and balances that founders should be aware of, like, should I remember to pay my credit card bill so I don't get a bad string on CIBIL or something like that?
I haven't looked like that. Matlab, practically it hasn't happened for my transactions, but some of the VCs can demand that as well for founders. So it's always better to pay your credit card bills on time. So yeah,
Or
but
you won't use your card and use your mom's or dad's card.
yeah, but normally a net worth certificate is required of the founder to be attested from a CA. Apart from that, CIBIL and all, I don't think for raising equity per se, it's sacrosanct. For raising debt, obviously, your CIBIL and all these things will be required.
Got it. Thank you. I mean, this is something I was struggling with for a very long time. I had to ask someone.
Now we know.
Okay, awesome. I think Abhinav missed a lot of the session, but I have assured him that we would be covering a lot of this again tomorrow.
Yeah.
There's a few terms I think is relatively new, and a lot of founders would be relatively new to this entire process and understanding those financial terms. So let's
Yeah.
maybe do a deep dive tomorrow
Yeah.
and
Okay.
cover the basics, cover everything that a founder would need to know before they step into this entire fundraising process.
Okay. Okay.
Yeah. All right. Thank you so much for joining, everyone.
Thank you so much. I hope you all enjoyed the session.
Thank you.
Thank you.
Bye. Bye.